Have you ever watched price violently explode out of a range, felt that completely overwhelming urge to just jump in, only to watch the market immediately reverse the second you enter and completely blow out your stop loss? Listen, it happens to the best of us, but what if I told you that aggressive, frustrating move actually left behind a very distinct footprint? Today, we're diving into this explainer based on the Money Blueprint to unpack the exact formula for catching precision entries right alongside smart money using a powerful concept called the fair value gap. Let's get into it.
So here is our roadmap for today. We're going to cover the retail breakout trap, break down what a fair value gap actually is, go over the three-candle rule, identify high-probability setups, and finally, wrap it up with an exact execution strategy.
All right, starting with part 1, the retail breakout trap, or as we all know it, the FOMO mistake. Seriously, why do violent breakouts always seem to reverse right after you jump in? It's literally the most frustrating feeling in trading. You see this massive green candle rocketing upward, and your natural human instinct, that fear of missing out, just screams at you to buy. But here's the harsh truth. That impulsive, emotional reaction is exactly what the market algorithm counts on.
It's a tale of two entirely different mindsets. On one hand, you have the typical retail trader chasing the breakout, buying right at the absolute top of a massive candle, fully exposed and driven by pure emotion. But smart money? They do the exact opposite. They are patiently waiting for a retest. They aren't chasing anything, they let the market come to them.
Moving right along to section 2, the fair value gap in understanding market efficiency.
To really grasp what a fair value gap is, you have to understand how market efficiency works. Think of a perfectly balanced market as one where buyers and sellers are happily trading at every single price level. It's an even exchange. But when central banks and massive institutions suddenly inject billions of dollars, price surges so incredibly fast that only buyers or only sellers get their orders filled. That massive, unnatural injection creates a literal void on the chart.
And this brings us to an absolute foundational rule of price action. The market algorithm is programmed to seek efficiency, meaning it absolutely must return to rebalance that gap. The market basically acts like a giant magnet, naturally pulling price back into that empty void to match up those unfilled orders before it confidently continues in the main trend's direction.
So, how do we find these voids? That brings us to section 3, the three-candle rule for spotting the imbalance. When you look at a massive momentum push, that unfilled gap between the first and third candle acts almost like a glowing beacon. It's so distinct that some traders look at that empty space and ask, hey, is this a free money zone? Now, obviously, there is absolutely no such thing as free money in trading, but that unfilled gap brilliantly illustrates the exact territory where smart money waits to strike. Here is the mechanical anatomy of how to spot it. Anytime you see a strong expansion move, just look for a simple three-candle sequence. Step 1, identify candle 1, which is your origin candle. Step 2, locate candle 2. That's your massive, large impulse candle that shoots out. And step 3, find candle 3, the continuation candle right after it. Once you've isolated those three candles, here is where the magic happens. Look closely at the high wick of candle 1 and the low wick of candle 3. If there is an open, empty space between those two wicks, meaning they literally don't overlap at all, boom, you've found your fair value gap. That empty space represents unmatched orders just sitting there, waiting to be filled.
Let's jump to section 4, high probability setups. We need to filter out the noise.
Because honestly, if you try to trade every single gap you see, you're going to get chopped up. Here is your high probability checklist. First, trend alignment. You must, and I mean must, only trade gaps that align with the higher time frame trend. Second, structural break. That massive impulse candle we just talked about needs to break major market structure. Third is confluence. The highest quality gaps sit right inside or directly above an unmitigated order block. These rules are your armor against sideways markets.
It's actually incredibly easy to separate a great trade from a terrible mistake. If a fair value gap pops up in a choppy, sideways market and there's no structural break, the verdict is simple. Invalid. Cross it out. Don't touch it. But if you have a violent impulse move that creates a clean break of structure, that is your high probability setup right there.
And if you want to push those probabilities through the roof, look for this specific combination. Order blocks represent where institutions accumulated their positions, right? Well, fair value gaps represent the explosive speed leaving that accumulation. Combine an order block with the fair value gap, and you have created the ultimate A-plus institutional zone. All right, bringing it home with Section 5, Exact Execution Strategy. This is your trade blueprint.
Here's your step-by-step entry rulebook so you can safely target opposing liquidity. Step 1, identify a clear break of structure. Step 2, locate that 3-candle impulse move that caused the break. Step 3, mark the open gap between the wicks of candle 1 and 3. Step 4, actually set your limit order right in that FVG zone. And Step 5, which is absolutely crucial, place your stop loss safely past the origin candle to protect your capital.
Now, for those of you who want an incredibly tight risk-to-reward ratio, you need to know a fancy term called consequent encroachment. It sounds complex, but it's just the exact 50% midpoint of your fair value gap box. Instead of getting in at the very edge of the gap, placing your limit order right at that halfway mark lets you run a much tighter stop loss. Institutions love to push price deep into that 50% mark before reversing, so it's a massive advantage.
Seriously, there's nothing quite like watching price pull back perfectly into that imbalance zone, tap the 50% midpoint, and then immediately launch away for a massive gain. It's beautiful. It perfectly illustrates the incredible payoff of just sitting on your hands, letting the market come to you, and filling that institutional void with absolute precision.
So I have a serious question for you. Are you going to keep nervously chasing massive green breakout candles just because you're terrified of missing a move? Or are you going to start letting the market come to you? It's time to completely flip your mindset. Smart money doesn't chase price, and neither should you.
Let's recap the core rules of this blueprint. Stop chasing breakouts. When you see price surge, calmly mark your 3-candle gap. Wait patiently for the algorithm to retest that zone. Trade alongside the institutional volume, and always target opposing liquidity for your profits. Protect your capital and respect the gap.
And that wraps up our explainer of the Money Blueprint strategy. If this breakdown helped simplify smart money concepts for you, make sure you drop your favorite trading pair in the comments below, hit subscribe, and definitely check out the moneyblueprint0.substack.com for more written breakdowns. But before you close this out, ask yourself, when the market opens tomorrow and that first massive green candle flashes on your screen, who is going to be in control? Your emotions or your blueprint? Stay patient out there.